All right, our next guest thinks the tariff story is massively overplayed in importance. CNBC contributor David Zervos is Jefferies' chief market strategist. David, great to have you on a day like today. Why are we all overstating the impact of tariffs here? What are we getting wrong?
I just think we're missing the bigger picture, Melissa. The bigger picture is the deregulation story and the smaller federal government story and the movement of resources out of an inefficient federal government into a more efficient private sector. The reprivatization of the U.S. economy, as Secretary Bessent has talked about last week. I think that's the biggest story. I know that it can be disruptive. I know that it can take a little bit of a shine off the market as we move those resources out of the public sector and into the private sector, both labor and capital resources. But the longer term picture is just so optimistic for me. And I think we're getting bogged down in a tariff discussion that's just minutia in the grand scheme of things, to be honest with you. I think it is negotiating tactics. It's moved up. It's moved down. It's getting more geopolitical traction than it is actual economic traction. And the real storyline people are kind of forgetting about a little bit, or maybe not. I mean, the S&P is only down a couple percent for the year. So maybe the S&P is seeing through it as well. We're just making a bigger deal out of it than it is.
It's a very sort of intangible or unquantifiable thing, deregulation and the privatization of the economy, David. What makes you so certain that those, and it seems like those are longer term, positive impacts on the economy, that in the meantime, we don't fall into a recession or see economic damage before those good things may take over later on?
Well, Melissa, I think, look, there is a risk that as we do that movement back to the private sector, it's disruptive. And I think the administration would probably like to have disruption early, then they can blame it on the past administration and kind of start fresh 6 months to 9 months down the road at a slightly better place. So there is an argument that they kind of get aggressive early, make a few massive cuts, bring the chainsaws out, et cetera, et cetera. And we get a little bit of a wobble, and maybe that's what we're seeing. But I think the rate market cushions that. We've already seen a significant fall in rates. I mean, people were talking about 5% 10-year notes and north of that, as well as rate hikes just a few months ago. That doesn't seem to be working out too well. So I think you've got a cushion with the rates. I think you've got an administration that wants to go kind of quickly and early with an aggressive DOGE-style program as well as a dereg program. And I think you could have some disruptions as you make that movement. But the longer-term story, which is what equities should really be keying off of, permanent capital, is just a really positive story. So we're sticking with that. And I like the idea of having rate hedges to your equity positions. I love my risk parity trades. And they've held up great through all of this because we've had the rate rally to go with a little bit of equity weakness. So, again, the bond market's cushioning the stock market. That's a healthy position to be in. We didn't have that in 22, and we just barely got back to it in the end of 23 and 24. So I think there's a lot more positiveness out there than people are giving this credit for, and they're really focused overly on both, I think, immigration policies and tariff policies as something that's really going to drag this economy down when they're really sideshows to the big picture.